Hello, my name is Patrick, and welcome back to another weekly webinar here with Prime Ag. We've got a lot going on in the markets, both equities and commodities. We've got elections, we've got a USDA report this week, and we've got CPI inflation data this week as well. So volatility is going to continue, excitement, emotions. It will be an interesting week to say the least. Let's get rolling. We're going to talk about re-owning for risk management here. Here's our pros and cons list. Take a little bit of time to read through this, but ultimately what we're trying to do here is limit the downside risk. We think prices are good and worth rewarding, and then give producers an opportunity to participate in some upside, because let's face it, we don't know what is going to happen in the markets over the next 3 to 6 months, whether it's weather, whether it's Russia and Ukraine. There's a lot going on out there. So this was just kind of our list that we put together. Let's get into it. 2 steps to re-owning: sell cash, come back and buy the paper. The 2 strategies that we're looking at are buy the March 1460 call, and you would sell the March 1560 call against it. The other thing you could do would be to buy a January soybean futures contract and then sell a new crop September or November contract against it. So here's what that call spread is going to look like. Sell the cash beans 1450 here today, and that would automatically remove your downside risk, but it also takes out any topside potential by making that cash sale. What we're saying to do is come back and then re-own some of those bushels with a call spread, and like we mentioned, you could do a 1460 and a 1560. It'd run you about 30 cents. So now your downside risk is going to be extended another 30 cents, but it's fixed to that 30 in this particular position, and then you still have upside potential on the table if the market gets hot and decides to run. So at the bottom here, and you know, we've kind of got a wide spread, but if you have $12 futures at contract expiration, your net futures price on your farm would look like $14.20, and basically that's 30 cents off the $14.50 that you made your sale at. If the market were to go higher, you're going to get to participate in some of that rally, not all of it. There is opportunity cost here, but ultimately you'd get 70 cents. Bringing your price up to $15.20. So again, we can live with that in this scenario. The other thing would be a soybean future spread. This is a little bit more of an aggressive strategy and a little bit more complex than this is a straight call. So you'll want to talk to your advisor and figure out which one is going to make more sense for you. But again, you do the same cash sell beans here at $14.50. Again, that would take out your downside risk and topside potential if you were to leave that cash sale alone. What we're suggesting then is come back and buy a soybean futures spread. Now, your downside risk compared to the call spread is actually unlimited at this point. So what you're going to need to do is potentially budget a mental stop or a hard stop in the market. We use 30 cents on that call spread. So something to consider here would be 30 cents. Again, your top side now is theoretically unlimited in here. And what you can kind of look at and consider by doing this future spread versus the call is you're re-owning old crop on the board with that long front month contract, buying the January or even the March, and then you're selling the deferred month or new crop, and essentially you could consider that to be hedging your new crop. So again, depending on how the markets move in here, this can give you a little more flexibility as far as old crop, new crop sales go. But ultimately, you know, the point of this spread is to put it on and hopefully make some money. So again, you'll want to call your advisor, visit with us on putting this spread on going forward. Final thoughts. We're going to wrap this up real quick. The biggest thing as we look at all of this and in talking to farmers is what's the headache factor? Okay, do you want to store and condition and move in and out of bins this cash grain? Or do you want to just manage the paper, which you can do from anywhere? You can do it from your kitchen. You can do it from the Bahamas. You can do it from your brother's house, you know, whatever you want. So keep that in mind. You know, what's your headache factor in all of this? What is your mental capacity worth, you know, as we go through? Again, by selling the physical, you get some cash flow in here. Re-owning is going to tie up some cash, but ultimately you're going to net out more cash flow than if you just held the bushels in physical. The next thing we'd like to point out is this is going to help encourage you to look at some new crop sales because you've taken care of old crop, both the downside and some upside potential. And so with that in mind, guys will be more apt to take a look at what new crop opportunities are out there. You know, we feel that this market is volatile. We feel that there's some good pricing, and as you can see at the bottom, extend the good times. That's kind of our theme in here right now. Prices are good. We need producers to be focused. We want you guys to be able to participate in potential upside moves, but as always, we have to look at what the downside risk is in here, as far as holding our dollars together and being able to keep farming. So if you have questions, feel free to give us a call. If you need to get an account opened up, give us a call. We can help you out with all of that. Again, we hope you find these webinars useful, educational. We hope we make you think a little bit out there. And again, if you have any questions, here's our information. We're happy to talk to you. You guys have a great week. Thanks.